discuss with you about national income accounting and the GDP, the gross domestic product. So, in this lecture, I will try to discuss with you about the national income, measures of output, GDP versus real GDP, GDP per capita, shortcomings of GDP as a measure of economic well-being, and I will try to explain all these topics or subtopics in this lecture. So first of all, what is the national income accounting? And national income accounting refers to the measurement of aggregate economic activity, particularly national income and its components. Just like the aggregate is equal to total or gross. Means it's the total income or the product of any country. So national income accounting is the measure or the method through which we maintain the records or the measure the aggregate economic activity of any country. And that national income accounting is measured through gross domestic product. It's called very famously known as the GDP. It is the total dollar value, or you can say the rupee value, depends on in which country you are living, what currency you are using, is the total dollar value of final output produced within a nation's borders in a given time period at current market prices. Means GDP is the total market value of all the goods and services produced in any country during a given time period, and usually the time period is 12 months. So the GDP is also referred to as nominal gross domestic product and the current gross domestic product. So nominally, when we use the term nominal GDP, it means we are using the value of the GDP according to the money or the prices, according to the amount of money or what we count nominally we have. Current GDP is nearly same. It means when we calculate the current country's GDP and the total amount of that output converted into the currency or the money, that is called the current GDP at current rates, current prices. Measuring gross domestic product, there are different methods to measure the gross domestic product or GDP. So there are most three famous measures we measure or calculate the GDP, the total output of a country, and that is the expenditure approach or the expenditure method, and it includes this CIG and net of the export. C stands for the consumption expenditure, means how much consumers are spending on their daily purchases or their routine purchases, and another is for I, and I stands for the investment expenditure, and this is the private investment, the firm's investment. We will discuss it in detail that when we talk about the consumption expenditure, it means we are talking about the durables and non-durable goods. These are those goods which are not for the business purposes, but these are purchased for the daily usage by the consumers. And investment expenditure is the business's expenditure which is spent by the businesses for their capital purchases or for depreciation is also the part of the investment expenditure. And in the investment expenditure, there are housing investment is also included into the I. And third expenditure is the G, that is G for the government expenditure. In every country, there are different types of the governments, means it's different levels from the local governments to the federal governments. And all these governments, they pay different expenses, salaries, wages, and they purchase various items, weapons, build roads, and many other things their governments are also purchasing. And then we add net of the exports. It means if you use here that we add exported items because these exported items these are not sold in our country but these are sold outside the country. They are went out of the country, but the exports are the products of the country whose GDP we are measuring. So that is why we include the export values and we minus the imports because these are those items we have purchased from other countries. These are not our products. So the net of the exports, if the imports are greater than exports, then we minus the difference from CIG. If the exports are greater than the imports, then the value will be added to CIG, so it becomes the GDP. So gross domestic product, according to the expenditure approach, is the expenditure when we add these types of the expenditure, consumption, investment, government, net of exports. Another technique to measure the GDP is the flow of income approach. So households supply businesses or business with the factors of production and return of payment in the form of wages, profits, rents, and interest. So there is one concept in the economics, then we call that one the flow, circular flow of income. So if you check that circular flow of income, that income circulates in a circle. If someone is spending, on the other side, another party is receiving. So expenditure of one person or one business is the income of another person or another business. So income, households, the households mean those any person who is working on behalf of his or her family, who is earning living for his or her family. So households, these are the main source of the supply of the factors of production. They supply the labor, they supply the land, they supply the capital. Even they are the entrepreneur. They are the suppliers of the entrepreneur ability. And in return, labor earns the wages, capital earns the profits, entrepreneurs earns the profits, and land earns the rent, and capital earns the interest. So the third approach or the third method to measure the GDP is the value-added approach. It aids the increase in value at each stage of the production